In this video lesson, we'll be discussing behavioral patterns when trading. Any experienced trader will tell you it is essential to have an understanding of how you typically behave under various circumstances that frequently occur when trading, as this information can shed valuable light on some of your strengths and weaknesses as a trader. Now listen to the two extremes described for each scenario and ask yourself if you truly find yourself participating in this way. Okay, scenario A. When you find yourself up significantly on a trade. Do you get anxious or seek any reason to exit to ensure locking in some type of profit? Or do you sit back and look to turn the trade into a home run, sometimes causing you to forfeit unrealized gains? Next, scenario B. When you're up a substantial amount on the trading day. Do you sit back and try to avoid trading in order to ensure a winning day? Or do you vigorously seek out more trades, sometimes causing you to give back more than half of your profits for the day as you recklessly enter into as many trades as you can find? Scenario C. When you find yourself down significantly on a trade. Do you get mad at yourself and exit the position as soon as you can, regardless of what exit price you may receive? Or do you find yourself holding onto the position for dear life, contemplating doubling down to improve your average price, using hope instead of reason? Scenario D. When you are down a substantial amount on a trading day, do you sit on your hands regardless of what trading opportunity may present itself as you fear losing more money? Or do you frantically try to find any trade possible in an attempt to recover your losses? In all of these before mentioned scenarios, both psychological extremes were identified. While it is normal to express characteristics described in these scenarios, a successful trader learns how to suppress those tendencies and instead act upon the situation at hand with reason, not emotion. Here are some reasonable solutions to the before mentioned scenarios. For scenario A, when you're up significantly on a trade, look to take some profit by exiting up to half of your position during the first true sign of weakness. For instance, if there is a sudden turn in price action. With the remaining shares, seek to place a stop behind a key level, moving average, or trend. In scenario B, when you're up a substantial amount on the trading day, look to stay aggressive, as you are clearly trading well under the current market conditions. However, if you find yourself stringing together a few losing trades, consider stopping as the market may have slowed down and become more difficult to trade. Try to always walk away with over half of your profits when up substantially on the trading day. For scenario C, when you are down significantly on a trade. Always try to cut your losses as soon as possible. You can always re-enter the stock again at a later time if it deems worthy. Try to avoid the temptation of moving your exit back in order to stay in a position, as this often leads to greater losses. If you do unexpectedly find yourself down a significant amount, quickly seek a nearby level that can provide aid. If you can't find any, then exit immediately at the best available price. And scenario D, when you're down a substantial amount on the trading day. Obviously, no trader wants to be in this position, but if you do find yourself in this predicament, you want to make sure you do not lose more money than you can realistically make back the following day. Therefore, try to manage your profits and losses wisely. Keep your losses as small as conceivably possible without hindering your opportunities for profits. If you find yourself stringing together a few losses, then slow down your trading. Enter into only the absolute finest trading setups you come across. Remember, trading is just as much an art as it is a science. That art involved with trading, in large part, is due to emotion. A trader must embrace and conquer the psychological struggle in the market and must seek to successfully use it to his advantage. When you find yourself clouded with emotion, you inadvertently stray from the fundamentals. It is then, when reason is gone, poor decisions occur. Now moving on to common personality types that conflict with logic when trading. First, the over-aggressive trader. This type of trader tends to substantially overtrade each trading day, often recklessly entering into as many trades as he or she can find, and typically enters trades with more shares per position than he or she should. Furthermore, an over-aggressive trader has a bad habit of averaging losing positions by doubling down. Now, the exact opposite of this is the trader who is too passive. This type of trader is ruled by fear of losing money, and consequently trades scared, often exiting positions prematurely. Moreover, traders that are too passive typically enter positions with less shares than they should. Next, there's the trader who is simply too lackadaisical. This type of trader is frequently not prepared for the trading day, does not actively seek out trading opportunities, does not analyze trades after exiting positions, and does not express an eagerness to succeed. And then there's the over-emotional trader. This type of trader is overly concerned about losing money when trading, and does not allow reason to dictate his decision-making. Furthermore, this type of trader expresses abnormally large highs and lows of emotion directly correlated to his trading performance. Now, there are two more problems that routinely interfere with a trader's mindset. They include the following. 1. Overconfidence. Researchers have found that often people have a tendency to overrate their abilities, knowledge, and skill. This proves especially true when trading. It is critical for traders to constantly seek and weigh quality feedback. Moreover, it is important not to trade outside your capabilities. And 2. A skewed perspective. In considering a decision, often traders put too much weight on the first information they receive or see, hence anchoring their subsequent thoughts. They often justify their decision by seeking information that supports their existing point of view, while avoiding the information that contradicts their opinion. Therefore, when considering a trade, try to allow logic and facts to dictate how you interpret the information presented, not opinion. You will find that most people can understand the fundamentals of trading and all the trading setups that come with it. However, few can accurately grasp the mindset needed to effectively trade the market. Now here's a list of qualities a successful trader often possesses. These traits must be practiced each and every trading day, as they are the underlying edge that separates an average trader from a great trader. 1. A successful trader takes trading very seriously, but does not let trading performance affect his or her life. 2. Is aggressive but not reckless, both with losses or share size. 3. Is passionate about trading but does not allow emotions to sway reasoning. 4. Uses a trader checklist, seeking information from numerous sources and weighs all the information without bias. 5. A successful trader continually examines and analyzes performance in order to identify ways to improve. Ultimately, the message is simple. Seek to improve each and every day you trade. Learn from your mistakes as well as your gains. Review every single trade you make. Analyze what happened before, during, and after you made that trade. Contemplate what you did that was effective and what you could have done better. These valuable thoughts are often forgotten once the trade is over. However, these thoughts are precious insight on ways to improve. Strive to learn as much as you possibly can from each trade you make. This will help you understand and improve dramatically as a trader.